Tired of chasing price with no structure? What if you could ride volatility like a pro using one classic indicator that shows range and trend together? This strategy uses Bollinger Bands, which wrap price in dynamic support and resistance levels based on volatility. The bands expand when the market moves and tighten when it's quiet. We look for band squeezes, breakout direction, and rejection signals to enter high-probability trades. No guesswork. Buy rules. First, confirm a trend or breakout direction, price rising and breaking above the middle band, 20-period SMA. Wait for price to pull back toward the lower band in an uptrend. Look for a rejection candle at the lower band, a wick or bullish engulfing candle. Enter buy as the next candle confirms bullish strength. Set your stop loss below the recent swing low or just outside the lower band. Target the middle band first, then the upper band for larger moves. Sell rules. Confirm a downtrend or bearish breakout, price below the middle band. Wait for price to retrace toward the upper band. Spot a bearish rejection candle at the upper band, like a pin bar or bearish engulfing. Enter sell when the next candle confirms downside pressure. Put your stop loss above the recent swing high or just beyond the upper band. Target the middle band, then the lower band for profits. Bollinger Bands are best when markets are trending or showing volatility expansions. Avoid entries when bands are extremely wide or directionless. Always risk 1 to 2% per trade and use price action confirmation to avoid fake signals.